Central bank digital currencies, CBDCs, are advancing rapidly in monetary systems worldwide. Several countries have already taken the plunge, serving as experimental bases for others. In China, the ECNY was launched in pilot form in 2019. This electronic currency has been in circulation since 2021. By the end of 2024, it had already accumulated more than 7 trillion yuan in transactions, the equivalent of nearly $1 trillion US. At such a scale, every payment becomes a strategic signal, projecting Chinese power far beyond its borders. In Russia, despite sanctions, the digital ruble, tested since August 2023, is set to move toward full deployment in 2025. The European Union, meanwhile, continues its slow transformation. The digital euro, under preparation since November 2023, is expected in 2026. Behind Europe lies a broader reflection on modernizing payments and safeguarding monetary stability. In the United States, for example, Trump ended the virtual currency experiment in order to deepen studies and research into its real impacts. In Africa, Nigeria launched the Naira in October 2021, becoming the first African country to put a CBDC into circulation. From an initial 2.5 billion Naira in circulation, the Naira had reached over 10 billion by the end of 2023, a growth of more than 300% in 9 months. More than 13 million wallets have been opened, but only 1.5% are truly active, showing that adoption remains fragile. 3 years after its launch, the total transaction volume does not exceed 29 billion Naira, around 35 million euros, a modest figure compared with the trillions moved annually through traditional electronic payments. Clearly, euphoria is giving way to caution. This is the path chosen by Morocco. Bank Al-Maghrib is experimenting with the e-dirham in pilot environments, testing its use for domestic payments and exploring its potential for cross-border transactions. The objective is not to lead, but to understand. The e-dirham is envisioned as an instrument of modernization and inclusion, but always through the lens of security, stability, and monetary sovereignty. These examples highlight the diversity of models and choices. Among the countries that have taken the leap, some entrust central banks with the full management of the digital currency. Others prefer to delegate to commercial banks, while still others opt for a hybrid approach. Whatever the formula, private banks will have to reinvent themselves. They are no longer just counters or distributors. They will become technological integrators, trusted interfaces in a monetary universe now written in lines of code. In any case, CBDCs may not yet be visible in our pockets, but they are already reshaping the backstage of monetary power across the globe.